that possible?
Yeah, for sure. My name is Daniel. As an intro for the recording that we just started, and I work with a platform of World Financial Group, but I also work with we have an education arm called World System Builder, and we run a series of actually 5 or 6 different workshops. And today is a workshop called Proper Protection. And we're skipping one about an overview of general financial literacy. Then there's one on budgeting and getting out of debt. And now we're on to proper insurance protection. And so we got about 30 of us here. And let's jump in. As a disclaimer, we try to do everything we can to keep everything accurate and up to date. And this is not an offer to sell or solicit that you're going to buy insurance. We're not going to send you an application after this. Don't worry. But we talk about a 30 by 30 campaign. And as a firm, we think we can educate 30 million families by 2030. One second, I have someone unmuted. And I don't know who it is. There we go. And we think we want people to be a part of a campaign that's changing the financial industry and really bridge the financial education and financial independence. I think most people don't buy the correct financial products because they don't know. They don't know which ones. One second. My computer. I have a power cable issue. It's in and out, so we're good. But here's what we're going to learn today.
Can anybody hear me?
I can hear you. Yep.
I'm not getting no sound right now.
Click on your mute, a little up arrow, and then click on. Oh, you can't even hear me. What am I talking about? Let me put it in the text. It'd be nice to just tell them, right? But someone else want to text them and figure it out. But we're going to talk about, my understanding is you guys assist in the insurance industry to help market financial products. But this is a generic or a general course. And so we're going to talk about the X-curve concept. We're going to talk about why proper protection is the foundation. And then we're going to talk about the value of properly protecting your assets and your liabilities, and how this benefits someone's overall financial strategy, and then most common questions and mistakes. This is what we call a financial foundation, and we built our entire organization on this. We have in general, we have about 50,000 licensed reps. And so we are a big firm. And it mostly talks about figuring out this financial foundation where instead of sitting down with an average family and doing a financial plan, we can say, hey, here's four financial industries. And people should have a good plan for all 4. They should have a good protection plan. They should have a good debt management plan and getting out of debt. They should have a good emergency fund plan, as well as a good investment plan. And so we're going to talk about just the protection side things today. We're not going to talk about the rest of them. We have other workshops for those. If you want those, talk to Lawrence and she'll set you guys up. But the X-curve concept is basically a simple way to show the relationship between taking care of your responsibility and building your wealth. It theorizes that in general, a person's responsibility decreases and their wealth increases over time. And so what I mean by that is that it provides a clear approach of building a financial foundation with different options. When you're young, you typically have very little savings, but a lot of responsibilities. But when you get older, you typically don't have much responsibility, if maybe you do it right. And when I say do it right, if you start to save and invest when you're young, you build wealth when you're old. And if you don't have any wealth, basically the X-curve becomes just 2 parallel lines. And so when you're older, you want more wealth and less responsibility. And so when we put the X curve together, we basically say you're going to decrease your responsibility as you get older, but you're going to increase your wealth. And when you're young, you're generally less secure. And when you're older, you're generally more secure. Now, this is almost based on your financial age as opposed to your chronological age, where some people, maybe they're 30 years old, but their financial position is like they're 50. And other people, they're 50 years old, but their financial situation is like they're 20. And so we want to know, hey, we want to move people from generally less secure to more secure. And the amount of life insurance someone should buy is usually the amount to cover their responsibility. So if I pass away and I have 2 kids, a wife, I want to make sure, hey, that's how much I should buy. What is my responsibility? And then when I get older, how much money should I save? Depends on my responsibility. How long am I going to live and what is my retirement going to look like? And so those are the 2 things we need to do. We want to do the insurance side and we want to do the investment side. And so the X curve concept, we have a quiz. According to X curve, should you wait until you pay all your responsibilities before building wealth? False. If we said wait till you're out of debt before building wealth, wait till insurance is paid off, what happened is nobody would ever start saving, because many times people never get out of debt their whole life. Or according to responsibility curve, you should have more responsibilities when you're older. We live in 2022. Many people have a chance to do 2 or 3 families in a lifetime. And so they turn 60 and they're still working with young kids. But in general, you want to have less responsibility as you get older. And the last question, generally when you're young, you probably have enough wealth to take care of all of your responsibilities. Generally, that's false as well. And so life insurance is almost like a form of renting money. So if you don't have any wealth, you just rent it. And we look at, what are the most common things you insure? People buy insurance on everything nowadays. Car insurance, heart insurance, phone, wedding rings, house, vacation, pet. And the question is, how do I protect my responsibility or my asset? Or can I purchase a warranty on my income, right? We look at this and say, we insure these things, but the greatest asset that we want to insure is ourselves, our own life. And so basically life insurance just protects families from the burden of financial responsibilities. And so if I pass away, is there a group of people that relies on my income or my value? And if there is, I can buy a policy. And life insurance can be used for other things, but the most common form is to protect income. And in exchange for premium payments, the insurance company provides a lump sum or a death benefit to beneficiaries. And it's basically the way it is that an insurance company is just a company with a lot of cash. In my opinion, I think in the next 2 or 3 decades, we're going to see technology companies getting into the life insurance game. There's a barrier of entry of you need billions of dollars in a reserve to run a life insurance company. And right now there's tech companies out there, maybe like a Google or Facebook, or that have lots of money. So they could put a reserve like that together and do very good on underwriting. But here's a matter of perspective where a letter, it says, I am your life insurance policy. You and I have similar purposes in this world. It's your job to provide food, clothing, shelter, schooling, medicine, and other things for the ones you love. You do this while I'm kept in a safe place. I have faith and trust in you. Out of your earnings will come the cost of my upkeep. At times, I may appear insignificant to you, but someday, and who knows when, you and I will change places. One second. You guys getting that flashing? Me too. Well, let's move on. Let's keep going. Maybe that's a part of my keynote. You and I are going to change places. When you're laid to rest, I'll come and do your job. I may provide food, clothing, shelter, school, medicine, and other things for your family you continue to need, just as you are providing now. When your work and labor are done, mine will begin. Through me, your hands can carry on. Whenever you feel the price you're paying for my upkeep is burdensome, remember I can do more for you and your family than you'll ever do for me. Knowing how a policy like me works will help you understand my role in your overall financial foundation. Together, we can help protect the future of your family. If you do your part, I will do my part. And so, other purpose of life insurance is to give to charity or an estate preservation equalizer, where let's say I give one of my children $50,000, but the other one doesn't get any money. Maybe I want to catch that up. Or with business, tax planning, or a lot of times, more so in the immigrant market, we say if someone moves to Canada and they're 40 or 50, instead of saving a couple $100,000, they can just buy the money. They just buy the wealth and say, hey, I'm going to give this to my children and create some wealth through a policy. But like anything, I think with life insurance is probably the most misunderstood product in the marketplace, where people ask, well, there's so many questions. What's the right type? And there's only two things that have this much controversy, which is politics, religion, and life insurance. Because if I ask, what's the best type for me? And I Google it, I get a million options. Nobody, Google has lots of opinions, and some of the options can be overwhelming. And nobody wants to talk about dying. So let's go through and figure out, how does premium determine? Premium is determined based on your health. So the older you are, the more you pay. The heavier you are, the more you pay. The more health issues you've had in the past, the more you pay. If you're on medications, the more you pay. If you smoke, typically tobacco is one smoke per year. You're a tobacco user. If your parents have health issues, you might pay more. Or you have a bad driving record, a couple speeding tickets, you're going to pay more or get declined. Or if you do any high risk activity. But for the most part, age is the main determiner, plus weight and health issues. That if you have too many issues, you can't get coverage. And some things are not determined. We don't ask about things like hair color. Doesn't matter what hair color. If you're dark hair, gray hair, even if you're gray hair and you're in your 30s, doesn't matter. It doesn't matter what religion you are. It doesn't matter if you have riding a bicycle or your eye color. But we do ask about things that determine how long you're going to live. And so the number one sin, I think, in the financial industry is that people don't know how much coverage they should buy. And they buy a little itty policy when they should have bought a bigger policy. And so the DIME method is a simple way for people to calculate how much life insurance they need. You buy life insurance to have enough coverage for a potential loss. Nobody would buy $100,000 coverage on a $500,000 house or $20,000 on a $50,000 car. But in the insurance industry, we see all the time they're worth $500,000, but they only buy a $100,000 policy. If someone passes away, there's typically four things that we want to pay off. We want to pay their debt off. We typically want to do income times 10. Unless they're young or have lots of children, maybe you go income times 20. What I mean by that is, if I make $50,000 a year, I might need to have $500,000 in life insurance. If I'm able to invest that, I could probably get 15 or 20 years of income out of it. But what we see in reality is most widows don't invest the life insurance money because they're terrified of losing their spouse again. So when they get that money, it's more money than they've ever managed. They usually put it in something that's very secure. Typically, you want to cover the mortgage off. So let's say there's a $300,000 mortgage, and cover the children's education. So if they have $100,000 in debt and $50,000 for the kids' education, they might need a total of $950,000. $950,000. Bump it up to $1 million. I don't think is a ridiculous number. But for most people, if they pass away young, they need this kind of money to protect their income. The type, once you know how much you need, then we figure out the type of life insurance. So there are two main types of life insurance. One is term. Think terminate. It terminates at a certain time. It doesn't auto terminate. What happens is the price gets so expensive, you end up terminating. And the other one is permanent. Now, permanent doesn't always mean permanent. In the insurance world, all permanent means is there is cash value. But many permanent policies are actually term policies with cash value. So I can add cash to a term and make it permanent, although the policy is not going to last longer than me. So it depends how it's structured. Let's dive into it and look at some of these options. A term insurance is the simplest type of insurance. Like renting an apartment, the insurance company pays a death benefit should anything happen within the length of the term. So there's different lengths of term. If I got annual renewable term, they just, every year I get older, they charge me a little bit more. They don't redo the medical, but if I'm going to get older, they charge me more, which means I underpay in the beginning, but I overpay in the end. If I'm planning on canceling a term, where term is meant to match a specific need, either protecting my income, protecting my mortgage, my car payment, maybe my until I retire. But a 5-year level term is usually the most common to protect a mortgage. Now, typically mortgages are 10 or 20 or 30 years left, but a bank sells 5-year level term many times because that's their risk. You go to TD Bank, they're going to sell you a 5-year term because after 5 years, you're going to go somewhere else with a mortgage, so they don't really need to lock in that life insurance payment most often. A 10-year level term is the most common when it comes to a personal plan for the lowest cost. And a 20-year term is the most common if a husband and wife have 2 kids. Or they have kids, when there's a family policy, 20-year term hopefully gives the kids enough time to move out, and then the price is going to jump up. So we match the term to the need. Sometimes you get group term, but many times it's not big enough. Nothing wrong with group term. It's a nice bonus. Usually it's also very inexpensive. So if you have options to get group term, buy as much as you can, especially if you have health issues. Group insurance is underwritten as a group. So if you have a minor health issue and you can still get access to the group policy, buy as much as you can. And then accidental death policies, or AD&D, it says they're inexpensive, but may not be a good value. You must die because of an accident, or a dismemberment is usually 2 joints, which means if I lose my arm, I got to lose it above my elbow. If I lose my leg, it's got to be above my knee. Nobody likes that. Or if it's blind, it has to be 1 arm, 1 leg, 2 legs, 2 arms, or 1 eye, 1 arm, or some kind of combination. So these were built in maybe the 50s and 60s when workplace wasn't maybe as safe. And or if you die by accident, you know, the joke is if me and my wife are in an accident and the ambulance is coming and I'm going to die for sure, but I didn't die because of the accident. I'm going to die on the way to the ambulance, or I'm going to die in the way to the hospital. I got to be dead when the ambulance gets there. Otherwise, an accidental death is not going to pay. It's going to be due to blood loss or organ failure or some other cause other than the accident. So my wife's going to have a tough decision if we're in that situation. I talked her through it already, so she knows the right thing to do is to put her high heels on and get rid of me. And so here, I got a $500,000 policy on a 30-year-old female, and the premium is about $400 a year. So it's very inexpensive, $30 a month, give or take. And for the first 20 years, it's $400 or $8,000 for 20 years. So if someone passes away between 30 and 50, a term insurance plan is so inexpensive. It's a shame that people don't buy more of it. And one of the benefits of term, very inexpensive. After this term renews into what's called a yearly renewable term. This is an IA policy. I can tell because it renews to YRT. So the year 21 is 2,000, then 2,100, 2,300, 2,600, and so on. So for the next 20 years, the client would pay over 90,000 because the premium is going to go up. So term is good if you plan on canceling it. And that's the most common when you have young children. Because when my children are 25, I might not need term to protect my children anymore. So if someone puts 100,000 in and they die before the age of 70, they're going to get 500,000 out. I think it's a great deal, even with the renewal. Term insurance, the advantage, low cost. And it's a liability for a specific amount of time. If you plan on canceling it, you never pay a renewal. The disadvantage is you're only insurable for a specific amount of time, and then the premium jumps. The policy will lapse if the premium is missed. So if you miss a premium, the policy doesn't stay in force. The premium feels like it's wasted, where there's two risks with life insurance. With term insurance, if you die, they pay, but the other risk is you might outlive the policy. So you feel like it's wasted if you outlived it. And then if you become uninsurable later, you got to go to a different carrier and pay a little bit more premium. And then if you wait too long, maybe you can't upgrade the policy. One of the other advantages here is you can upgrade. And typically, the more expensive term insurance is in a competitive market, it's because of the upgrade options. So if a company has really good permanent coverage, they can charge 5 or 10% more in their term because the client, we know, hey, there's an upgrade option here that no one else has. We want to convert this thing later. It's almost like a bridge. Let's get some term now, get you out of debt, and then we can convert it later. Because term insurance is for a set period of time, you might live longer than the set of term. Now, the rational person, there's an argument out there that says, hey, let's do by term, invest the difference. And the logical person says this makes sense when we put it on a spreadsheet. But the reality is many people don't invest the difference. There's no incentive for them to do so. Or they're in the market and they don't know how to invest. And so they just save the difference or spend the difference. So when people want insurance that's going to pay out for sure, we think, hey, how long are you going to live? More than 20. I will live more than 20 years. That's my plan, right? I'm in my 30s. So if term insurance is like renting an apartment, permanent insurance is like owning a home. There's a cash value associated with the account that can potentially generate interest to help pay for the higher cost of insurance as you get older. So in general, the cost of insurance as you get older is always going to go up. So with a permanent policy, you pay more in the beginning so that you don't have to pay more in the future. So it's just like prepaying. Now, this doesn't work with car insurance. If it did work with car insurance, I would prepay my whole life so they can't redo my medical, redo my driving record, because as I get older, now it's been coming back down. But when I was young, I paid a lot more in car insurance than I do now. But I know I'm going to get older, so I know that cost of insurance is going to go up. So when it comes to permanent insurance, there's two main types: whole life and universal life. The main difference is the insurance company takes the risk with the whole life, and the individual who buys the policy takes the risk with universal life. That is the main difference, and it is a very substantial difference. They're two totally different worlds. And so let's look at these two things. In a whole life policy, you keep your policy the whole life. This is the oldest form of life insurance, and you can sell your insurance back to the life insurance company. So what happens is you pay a premium for your whole life, and the overpayment early on covers the later cost of insurance. So the insurance company doesn't have to charge you more later. And so some of the benefits of this, you can do a for life payment, but most people do a paid up feature for personal policies. So I can say, hey, I want to pay 20 years, but I want to keep my policy my whole life. We say not a problem. You get a quality guaranteed interest rate on your cash value. On your cash value. So there's a good quality interest rate that you can't get in the fixed income world. Also, it's tax-free. So fixed income in the investment world is the worst way to get taxed. But in the investment world, you get a guarantee there's no tax. The cash value is accessible different ways. Some of these are taxed. Only a bank loan has zero tax. A policy loan is no tax up to what you put in, referred to as the adjusted cost basis. And the policy may receive dividends, where just like if you own an insurance company or if you own a stock, you get paid a dividend. So there's 4 parts to a whole life. Let me draw it out here. There's a base policy. And what happens is when you own a base, if it's a participating policy, there's going to be a dividend that gets paid out. Now, the dividend is never guaranteed. It says it all over every illustration. But Equitable, for example, has paid their dividend for 100 years. I don't think there's a Canadian insurance company that's missed a dividend. I've never heard of one. There might be one. So what happens is you get a dividend and then you buy more coverage if this is your death benefit. So we call that paid up insurance. So you buy a base, let's say it's 100,000. It might be worth 400,000 when you're age 100. Now you can also add what's called extra deposits. Extra deposit is if the dividend helps it grow, you can add extra deposits and it will grow even more. Now, if you want to have cash value in the policy, usually you have to put it there. You have to add the cash value. Now, in a whole life, the cash value must be equal to the death benefit at age 100. So it ends up looking like this. So at age 100, if you have a policy worth 400,000, that is your cash value and your death benefit, and it stops growing. And then early in the policy, this policy is so small in the beginning, they typically do a YRT term called an enhancement to get a bigger policy early on before it starts growing. So the actual trajectory of the policy, where it start off here, be level for 5 or 10 years and then start to grow. But the different parts in there become confusing. Now, the better the contract, typically you add more parts, it becomes confusing. But let's look at this. This is a 20-pay policy. We have a base coverage of almost $250,000 and the enhancement of almost $250,000. So your total coverage is $500,000. Here, your base premium is we're going to round these numbers off, $5,000 a year. You're allowed to put an extra $3,600 a year in extra deposits. They call it accelerated deposits. We've chosen to just do $1,000 extra. So they could put an extra $3,000 a year. So the premium is $6,000 a year, very similar to a TFSA premium. Because this has no risk, when we compare it to a bank account, it does very, very well. When we compare it to the stock market, it's not really fair. It depends on which decade you're looking at. But here's an example. If someone puts in $126,000, so here we're putting in the cash premiums times 20 years, $126,000. If this person passes away early on, they have a $500,000 death benefit. At age 65, they have an $800,000 death benefit. 85, 1.3, and then age 100, 1.9 million. The cash value is equal to the future value of the death benefit minus your premiums that you have not paid yet. So there's no value in the beginning because you did a medical and you're very healthy. But when you are, for example, 85, they're going to have to pay out 1.3. So they'll buy the policy back from you for $1 million. They'll say, we'll give you $1 million if you cancel this. And you can go to the bank and borrow that $1 million like a mortgage on a line of credit. You can get a bank loan. And the insurance company will also give you what's called a policy loan against that with no credit check. And so that money is accessible. If you do it right, you can get it with no tax. So many times this type of policy, if someone says, I don't like the stock market risk, they want to put 126 into a policy and they want to pull 900,000 out. You can typically do 90% of your cash value when they're old. And so they say, hey, that's a great idea if you get them when they're young enough. No market risk and no tax. So it's a great option if you're healthy. Advantages of whole life. The number one way it's sold is people don't want to be in the stock market. You can pay it up. It's designed to last your entire life, and you don't pay tax as it grows. People can think, hey, there might be a conservative rate. Maybe they can outperform that rate somewhere else. You have to pay your premium. So if you don't pay your premium, you might lose the policy. And early cash values are based on overfunding. If you don't add extra money early on, usually there's very little cash early on. And so you can add and you build your own flexibility. That's whole life. The other option is universal life. So what happened was in the 80s, interest rates were in their 20s, maybe high teens. And the insurance industry said, this is very hard to sell. Whole life is hard to sell because a client can go to a bank and get 20%. And the insurance company said, our interest rates are based on a lifetime, not 5-year or 1-year contract. And the agent said, well, clients don't have, they just want to know what the best interest rate today is. So the insurance industry said, let's create a universal life. It's like a universal joint that anything can go in it. And so the way it's built is you always have a cost of insurance that has to be paid for a reserve. And so it has a flexible premium. They said, well, if we're going to give you different interest rates, we're going to make some changes. You can choose your premium. You can stop paying, you can overpay, underpay. The extra payment you put in on top of the cost of insurance goes to pay your future cost of insurance. And most policies are considered a yearly renewable term. So when you're younger, in your first 2/3 of life, it looks really good. But in your last third of life, it depends how much cash is in the policy. So let's look at this. You get a flexible premium, minimum and maximum. Here's one of the issues we have in the industry with universal life. Does the client want to pay the minimum or the maximum? Now, if you pay the minimum, you might not have enough money to pay for future premiums. So the policy will lapse if you run out of money. Some money goes to the cost of insurance. The rest of it gets invested into a third-party investment fund. Those investment funds can be positive and they can also be negative. This year, most of them are negative. So the client can choose the investment and they can access that money too. So the flexibility is good for the client who likes flexibility and is financially savvy enough to understand it. But if a client pulls out their cash value early on, they won't have enough cash value later on to pay the premium. So let's look at a policy. By the way, the better the policy, usually the more complicated the policy. The better the advisor, the simpler. But here's what it looks like. We got a $500,000 policy. The cost of insurance is about $400 a year. Just similar to term because it's a yearly renewable term. We're going to pay $6,000 a year. And the minimum and maximum are right here. A really good universal life, you're paying about half of the maximum if you want to be a max funding. And so here's what a policy looks like. Coverage year is what it is. Insured age, we're saying 30. We don't know the assumed primary rate of return, we guess. So if we say 6%, we're assuming the stock market does an average of 6. If we say 10, 8, 1, 2, that's an assumption that we have to guess on. Every year it's different and it's not 6. The annual charges is like term, so it's almost $400 in year 1. In year 10, it's $450. In year 20, it's $800. So you don't have a huge jump in premium like you do term, but it slowly creeps up on you. Now, if someone puts in $6,000, that gets divided between the fund value and the cash value. I'm sorry. It gets between the fund value and the charges. So the fund value is what you put in on top of the cost. So this policy has an extra $5,600, and we can choose to put that in an index fund or a mutual fund. After 10 years, they've had $74,000 if it grew at 6%. Now, some people say, hey, you don't get both your life insurance and your death benefit. The way it's built here, yes, you do. So here I would get my fund value is 5,609. I get $500,000 of life insurance plus my cash value. Now, for the first 10 years, there's a fee if you cancel. So your actual cash value is less than the fund value. So there's like a limit. But here, if you have 74,000 in cash, you get 500,074. When you're older, let's say you are 65 years old, you have 557,000 in cash value. Your death benefit is your cash value plus your death benefit. Now, if the market does well, there becomes a side account, which means this money, the interest on that money is taxable. So if you put too much money in, it creates a tax problem. If you put too little money in, it creates a lapsing problem where the policy might lapse. So to find the right premium, you got to tell me what the market's going to do. If the market does well, you could pay less. If the market does poorly, you could pay more. And it works out really well if you're a corporation and you want to hide money from the government in the form of taxes. You're okay over or underpaying and changing your premium. But when it comes to an average person, many times I don't want to pay more or pay less depending on the market return. But if the market goes down, if a company is hiding money where they have cash, they don't know what to do with it, and it's a owner operated, the owner can say, hey, if the market goes down, it creates room, we can put more money in it, so more money goes to their children tax-free. The average person doesn't always have that problem. They have the problem of, I just want to know what I'm going to get. So there's some variables in the universal life. If they put 210,000 in and they pay the whole way through, it's likely they're going to get 5 to 10 times what they put in. So it still works out well. Some of the advantages, flexible premium. I talked to a client today where they're going to do one for maybe $50 to $100, where the cost of insurance is closer to $30 and 70 is overfunding. And this client has a job for about 9 months and then lose their job for 3 months. They have a job for 9 months, lose a job for 3 months. And that's been their life. They're in their 50s. So this type of plan makes sense. They can triple their payment. Then when they don't have a job for 3 months, the policy stays in force. So that flexible premium allows you to overpay depending on your financial situation. You get a death benefit that's flexible, so you can have some that drop or increase. And it's designed to last your entire life. But that's not always how it works. So you get access to some cash value. It does not get taxed as it's growing. But this is the big X. Underfunded policies may require additional premium later in life. Now, the insurance companies don't care if you lapse the policy or keep it. In fact, they'd like you to lapse it when you get old. And if you do a guaranteed interest rate, like a GIC or cash in one of these policies, it tends to be conservative and it tends to look underfunded. And so it is basically term plus cash. And so you got to put enough cash in to pay the future term. If you cancel it, all the growth becomes taxed. So here's a quiz. Term insurance has flexible premiums. You can skip payments without the policy lapsing. False, not true. Or future term insurance renewal rates are lower. Also false. Future term insurance rates are higher, significantly higher. Group term insurance from your employer may terminate if you leave your employment. True. Many people say, I'm going to keep my term insurance. I'm going to get my group insurance. I have my group. That's great. But most people who get cancer, heart problem, whatever the issue is, they quit their job to take care of their health and they lose their group term. That's why it's very, very good on a cost size. Final expense is a type of term. Final expense is to cover a funeral. It's typically a non-participating whole life or a level cost UL. And universal life has flexible premium. That should be true. I'm not sure why it's like that, but it is true. You can overpay or underpay. If you underpay, your policy might not last as long as you thought it would have. And so different options, they all have a cost of insurance, and you can add things to a policy. So most policies that are sold and kept in force are actually combination policies. So what they actually look like is they have maybe a permanent policy, like a whole life, with a term, a 20-year term and a 10-year term. Lots of coverage when you're young. As the term starts dropping off, you're just left with something permanent to keep things going. A rider is something you can add to the policy for more coverage. Where people say, I want this covered, I want that covered. Everything can be priced. The most common two things are critical illness, where if I have cancer or heart attack or 25 other illnesses, or disability, which means if I can't work, I want to have my income covered. So the advantage is you get a tax-free death benefit to the beneficiary, tax-free living benefit if I got sick, or if I want to pull some money out. You don't pay tax if the policy grows inside the policy, and I can get access to cash value through policy loans, or we call collateral or bank loans. And then tax-free withdrawals of accumulative paid premiums, which is what we call the adjusted cost basis. On the bottom, if the policy is canceled, you may be subject to taxes and policy gains. Here's one of the problems. If I have a policy, and let's say it's a $1 million policy, and I have a cash value in here of $800,000. And I go and pull out the $800,000 in a policy loan. So I go take a policy loan or a collateral loan, either way. And then I decide I don't want to keep the policy. So I cancel the policy. At the time of canceling, that's going to trigger a policy gain, which is going to be taxable. And if I already spent this $800,000, it's going to be devastating to me financially. And so if you buy a permanent policy with the intent on pulling cash out, you either have to cancel the policy early in life or make sure it never gets canceled. So in a universal life, you want to convert a term insurance to a level cost. Other things we do lots of is we do insurance on children, where if my child passed away, maybe I want some time off work. Or the most thing we do is called a flexible guaranteed insurability, where maybe my son can buy more insurance later, but not have to do a medical later. So I can do the medical when they're very young. I got a wife. She's a homemaker, I guess. That's what she would be. She doesn't work in the workplace, and I have insurance on her. Single people, usually by the time you need insurance, you're not healthy enough to get it. That's what having kids and marriage does. You know, if you've been married for a while and have kids for a while, your health is kind of deteriorating. And then uninsurable, we have options with non-medical or guaranteed insurability options. And then we can do just final expense, just to cover costs. So there's different types of policies. Many times when it comes to insuring a child, we do critical illness first and life insurance second. The reason is, if my child gets leukemia, I need lots and lots of money. If my child dies, I just need to have a funeral. It actually saves me money every month. I don't have to buy food for the guy. I can rent out his room, all that kind of stuff, right? But if critical illness, it's much more costly. It's rarer, but especially in 2020. But if I have a critical illness, it's a major thing. We also do a lot if people are maybe skeptical of the government lockdown situation or whatever's happening with the government. They say, I want to buy critical illness in case I have a heart attack or cancer, and they buy coverage just in case that stuff happens. And so basically it's for recovery. Critical illness should be called recovery illness. Recovery insurance. What I mean by that is it doesn't protect me from getting cancer or heart attack, although 70% of claims are cancer and 20% of claims are heart attack. And my treatment in Canada is free for the most part. Sometimes pain medication is not free, but I still need time to recover. I need time off work. I maybe want to take a vacation. I want to do experimental treatment. I need to get, if I want to recover faster. And so things we use it for is time off work. Maybe get my spouse off work so she can cook me food or come visit me in the hospital, fly family and stuff like that. And also maybe see a better doctor. So you can go to a better doctor. Maybe my doctor I want to see is in Toronto and I got to fly or in the States. So if I think about, I don't trust our medical system here, maybe I want to go to America. I got to buy maybe 100 or 200,000 of coverage to cover those costs. So it's almost like an American health insurance plan. Disability is if you become disabled and cannot work, not for recovery, but for long-term sustainability. Typically, it's 60% of your income, and you can only buy one plan and stack plans, but you can't overlap. What I mean by that is group plans will pay out first, then individual plans. So if I have a group plan that pays 60% of my income, I can't buy another 60% of my income and get 120%. I can get 60% of my income. Then I can do things like cover my mortgage payment, cover my car payment, cover retirement savings. So I can buy disability coverage on other things, but I can't just max out and buy 10 times my income and then get hurt and sit on it. You know, a lot of people don't have a safety net if they can't work. And a lot of people don't have enough savings to last 1, 3, or 10 years. So we use that to protect your income. Because group plan pays out first, many self-employed people buy disability. We buy health insurance, or if you leave your employer, people switch to a personal health plan for prescriptions, dental, vision, and then we buy travel insurance. And most times we buy insurance, the rule is if there's a catastrophic risk, buy insurance. If it's not catastrophic, or for example, dental, I don't think it's catastrophic. I think it's a couple $100 every time you go, and $1,000 every couple of years if you have a cavity or you have a root canal or something. But if you have no cash and you're terrible at budgeting and you decide never to learn about budgeting, health insurance is wonderful. But if you got a good budget and you got some cash in place, sometimes you just want to self-insure when it comes to health insurance. Travel insurance could be wicked expensive. A heart attack on average in America costs about $75,000 to $100,000. So if something goes wrong, it's going to be very expensive. A lot of people buy mortgage insurance. Now, we used to replace a lot of mortgage insurance, less now. But here's how it works. Bank staff might not be properly licensed or trained. Premiums stay the same through the mortgage decreases. So I had a client, this was their situation. They had a house with a $200,000 mortgage. If they paid down the mortgage, their life insurance was also $200,000 because it's attached to the mortgage. They were paying an extra $2,000 to $3,000 a month trying to pay this off in 5 or 8 years. So they were paying off extra $30,000 to $35,000 a year. If they pay off their mortgage, they also pay off their life insurance. So I ended up telling them, take that extra $3,000 and put it in cash. Or invest it or work less or do whatever. So then they kept their mortgage balance at $200,000. In fact, they ended up paying interest only on the mortgage. They both had health issues. And it turned out one of them had passed away. So the life insurance paid off the mortgage. And I dealt with them about 5 years before that situation. So they would have paid it off, but they would have worked hard for 5 years and lost their insurance. But if you own a personal plan and that $200,000 is separate and you pay off your mortgage, you still get your insurance. So by buying mortgage insurance, if you're unhealthy, you're forced never to pay off your mortgage because you also pay off your insurance. And also, this is a major one. Add a mortgage insurance. Typically, the bank owns the policy. So the underwriting and qualifying happens when you die. It doesn't happen when they issue the policy. The bank owns the policy, so they don't have to do the underwriting until later because you're not the owner. And so if you've been tested for high blood pressure and the question says, hey, have you ever had a medical test? And you say no, that's considered fraud because you answered no to a medical test, but you've had a medical test. So they're very shaky deals. You can buy simple issue, which means guaranteed to issue, but you pay more money. It's like going through security at an airport. If you pay more for your ticket, there's less questions asked. I don't know how good or bad that is, but that's how it is. And you can still protect. Usually you get a little smaller policy on simplified issue. Some of the questions is, does my life insurance cover me at work? Yes, it does. But it might not follow you when you switch employment. Why is it so cheap? Why is it so expensive? The cheapest policy I've sold this year is about $15 a month. And the most expensive policy I've sold this year is about $110. Sorry, 110,000 on the big side. So we do 100,000 a year. We do $100 a year, all over the place. But as you learn, there's many factors: gender, age. You want to look at all the benefits so you know what you're paying. And it's hard to do apples to apples when someone says, I want to build up some cash out of the market, and someone else says, I worry about my family dying. And so bigger policies tend to be sold with no fear. If I want to do small premiums, I'll say, Mike, what if you die? What if? And I scare you, and then you end up buying something, but it's tiny just to get rid of me. But if I say, hey, listen, why don't we talk about your kids and setting up like a play fund when if you pass away, why don't we have you spend, your kid's going to spend the insurance company's money, and let's set them up with some play money so they don't spend all your business. And let's start planning like a happy future. That includes life insurance, but people would rather protect their kids than to worry about dying young. So if you scare people, the premium goes way down. Do you think your health is going to get better or worse as you get older? Do you think your responsibilities are going to get higher or lower? Do you want a benefit that's going to help your overall strategy? And will you self-insure during retirement years? So this is a big one. People say, what's self-insurance? Let's look at self-insurance. What this means is, let's say there's two situations. We got situation here, husband, wife, and they have a cash account of 500,000. That's for retirement. Then we got another couple here. They have a cash account. This is a bag of money. With 400,000 in retirement because they bought an insurance policy for 200 grand. So now person A gets sick. That's a sad face. Person A gets sick. Here's what's going to happen to person A who's getting sick. He's going to go to his wife, and I'm going to say, my wife is named Jackie. Hey, Jackie, I have terminal cancer. I got a year or two left to live. Let's travel the world with this $500,000 we saved. And my wife is going to say, no, she needs that money. That's insurance money. If I don't have any permanent life insurance, she's going to say, how about we buy Netflix and we watch every show until you die? And because she's worried about her, continuing on. And so life insurance mostly doesn't protect my life. It protects my ability to spend my own money. So same situation over here. This guy gets sick. And this is me again. I tell my wife, hey, let's not spend that 400 grand we saved. Let's spend 100,000 or 200,000 of it. Let's go spend 150,000. Then when I die, the day I die, you're going to get repaid for all the money I spent. So it allows me to spend money on my way out. My last couple of years are more expensive. I can go see what I want, and I can make sure my wife is okay. And then she'll say, hey, we'll only spend up to the death benefit. If she says no, maybe I got 100,000 of cash value, I'll just spend my cash value. I don't have to, if I own the policy, I don't have to ask for permission. But so it allows me to spend my retirement if I have life insurance, if I'm married. Where a lot of people say your life insurance, by term, this, where I think if we settle it, your life insurance should last as long as your commitment. So if I'm married for life, I should have a whole life policy. If my marriage is like only till my kids move out, I should buy a 20-year term. And might not need $1 million of whole life, but maybe 1 or 2 years. And then enough to give my wife maybe a couple years on average. She'll outlive me 5 years. So we can calculate how much CPP she'd lose, how much of my pension she'd lose. A lot of stuff won't transfer over right away. So I need about 6 months to 5 years income. And once people see a need for policy, they say, I'm going to buy that. Most people would rather buy insurance to give their kids tax-free money than to buy insurance to pay the government's taxes. So it makes sense on paper. You got estate taxes, buy a policy, but people typically don't like to plan their taxes. They don't like to talk about taxes. And if you want to pass on some money to the next generation, give them a chance. We do lots of policies. But here's the quiz, just wrapping up. If you have term insurance, usually limited income, but you want to protect your family. It's like renting an apartment. It's better than homeless, and you should buy lots of term. The other option is whole life. You want a policy for life and a guaranteed rate. You like the G word. In universal life, it's intended to last your policy life, but you have a flexibility that can either benefit you or hurt you. Anytime the insurance company gives you something, they take something away. Anytime they give you something, they charge you for it. So we should work with, we believe that you should work with a licensed professional who knows some of their options and look at a holistic approach. Some of the mistakes I see is people should maybe buy term, get out of debt, and then convert their term. So if you have a major cash flow issue, you got to get your cash flow under control before putting a lot of money into a policy. And, taking action. And one of the greatest miracles is you can change your life by changing the way you think. I just recently talked to a client and he doesn't want to learn. He says, I don't understand technology. I don't understand this. And I thought, we can't help a guy who doesn't want to learn. So if you want to learn, this stuff's not very complicated. It's just not very simple. And we want people to be a part of our 30 by 30 campaign. We actually track everyone who's been through our workshops. And we think we can put 30 million families through our workshops by 2030. And we run them, by the way, we run our workshops 3 times a day. I'm one of the instructors for our entire country. And we can also do custom stuff for you guys. But we think people should learn about money and get the fine print before they buy a policy. And that's everything I know about life insurance. Can you believe that? We got a few minutes left. If we have a few minutes left, it's up to Lawrence and Cosman. But do you have any questions for me or comments? And if you want to raise your hand or just unmute and chat, you can also put it in the chat and we'll address it.
I'm usually the one talking, so I'm going to wait a bit before I jump in. So I'm going to let people jump in.
I actually do have a quick question for you. Thank you for taking us through that. That was super interesting. I'm curious a little bit about the flip side. What do you encounter that causes people not to buy insurance? Whether it's they've gone and talked to you a little bit and decided it's not for them, or their immediate turn off. So I'm a little bit curious about that side of the picture.
Usually it's they don't follow the right process. So I train salespeople to sell insurance in Canada, and usually if someone doesn't follow the right process and they get to the product before they go through, there's basically 4 steps we have to go through. They have to agree on values to say, listen, I want to protect my wife in case I die. So, okay, I'm married, they're married, easy to sell that. Then we got to go through a concept of, I'm okay paying an insurance company some money, so if I die, they protect my family. So I got to go through, hey, do I have a concept of paying life insurance? Is it a lump sum, monthly, whatever it looks like? I got to have some kind of concept in my head that I could draw on a piece of paper. Then I got to go through a strategy of, we're going to pay this for 20 years, then we're going to cancel it, or we're going to pay this for 20 years, it's going to last forever, there's going to be no market risk, or we're going to have lots of market risk, or what is the concept that we're going to be selling that goes with the strategy? So if someone says, I don't have a lot of money, I want to buy term, I want to protect my young kids, that's my values, that's my concept strategy, then the product is very easy. But if someone doesn't have their values lined up, the concept lined up, or the strategy lined up, the product, even today, we don't go through any product, but we could easily take that next step if someone's ready. If they say, I get it, the values, the strategies, and the concept have to be there. If they're not, you ask the client who didn't buy, why didn't you buy? They said, too expensive. And it's never too expensive. It's just too confusing. It's never a price issue. If people have money, it's not an issue. People have money, they spend a lot of money, they overspend on money. They're okay spending money they don't have. And people will do anything for their family. So that's not a problem. Does that help, Dawson?
That's amazing. Thank you very much. That's a really cool framework. So I appreciate you sharing.
For example, I bought lots of insurance in my lifetime. I got about 4.4 million of it. And I'd like to buy more, but the CRA won't my income is too small. They don't let me buy more, right? I'm limited, but I bought insurance because I got a wife and I got 2 kids at home. And someone explained to me that the only way you can keep a step, they said the number one abuser of a kid is a stepdad, a relative. And I would never want another male in my house with my daughter I got a 6-week-old daughter or a 3-year-old. And so I bought enough life insurance that my wife would never have a stepdad in the house. And I don't want someone living there. I don't want someone taking my kid to school. I don't want him picking up my kid from school. And I don't want my wife to deal with some kind of step loser, and so she doesn't have to get remarried. And I thought that, yeah, I'll buy a policy for that. That makes sense. That's an easy, 20-year term, put about a couple $1 million on there. Or I also don't want my wife to be an old widow who's broke, who has to get married to some bum who has a house, and move in with some loser and take care of my old widow who I couldn't take care of. And I think my marriage vows lasted, it's not till death do us part, it's till joint last to die. So my marriage should last, joint last to die. So then not till if I die, she's on her own. I said, listen, I got a few generations to take care of. And those concepts, I said, hey, I'll buy that. That makes sense for me. And I told my wife, you have enough money here, don't marry until my son is old enough to kill the stepdad. When he's old enough to fire a gun, then you could start dating. So.
Good. Well, thank you very much. Appreciate your answer there.
That's the true answer.
Yeah.
But no, any other questions? Hey, I got I'm
Yeah,
wondering.
Mo has a question there. Mohammed.
So, what advice to me? I'm 25 years old. So if I die tomorrow, I have no one who will pay my debts. So even the bank look for someone, they won't find anyone. So which plan I should get basically?
I think that's Mohammed talking, correct?
Yes.
And you should usually, by the way, this is not advice, but someone in your situation should, I'm licensed all over Canada, so you can reach out to me for specific advice. I'd love that. But if you plan on having a family later, and maybe it's likely that 4 to 5 women will be widows who are married and 1 to 5 men. So if I plan on getting married, it's an 80% chance there'll be a widow behind me. And maybe I want to buy a policy that covers that. Or I want to buy a policy that protects my parents, that I'm going to help retire them and they ain't going to make it without me. So I got to buy a policy to protect that. But you got to know what you're protecting first. Or you plan on buying a house, you plan on getting married, having 10 kids, you just don't have them. You need to buy lots of term so you can convert it later. But usually if you're young, you need to stack cash away. That's what you need to do. And then be in a position to invest. And maybe you want to stack cash in a policy. Does that help answer your question? I'm not sure if it helps, but
I did not understand stack cash in the policy. So what do you mean by that?
So you can build up cash value inside a life insurance policy that would rival an RSP. And I think a whole life will in the future might crush the RSP market because the whole life industry started before income tax. And there's a rule that you can't advertise them. So they don't have a lot of funding for advertising, but RSP is a government program that they have unlimited money for marketing. But, so there's different options. If you say, I want to have some money outside the stock market and I don't like real estate and I don't like alternatives. And I want to know, hey, maybe there's only 5 or 6 options. Insurance might be a good option to put cash for you to use, not for a death benefit.
Okay.
So
thank you. That answered my question.
But if there's not a huge need for life insurance, in the industry, we have the ability to create a need. So you always got to be careful if you meet a guy like me and I create a need that's not actually there, you might overbuy. But on the flip side, I might create a need and you say, hey, listen, I never realized when I make a vow to a woman, it's till she dies, not till I die, and so you put some money in a policy. Or maybe like your church, want to give money there too. So, but the more you look at it, the more attractive it should become, or the more or less attractive. So just keep looking at it and it'll either say I like it or I don't like it.
Thank you.
I have a website. I got a website. After we get off, I wonder if you could send me a review on my website and say, hey, I'm a good guy. This guy's not an idiot. And put something nice. Don't say those words, but say something in your own words. So, any other questions?
All right, thanks, Danielle. That was really, really interesting. I think you and I and Doug will probably be in touch for maybe a subsequent session in the future. I think it was super, super interesting. Thank you for the time that you took with us today, and we'll be in touch.
Yeah.
Thanks very much, Dan.
Thank you, guys.
Thanks. Bye.